A 60-day ceasefire between the US and Iran has immediately cooled global energy markets. With the threat of a major supply disruption paused, the geopolitical premium on crude oil has vanished. For India, this sudden drop in oil prices triggered a massive relief rally across equities. The prospect of a lower import bill is already stabilizing the rupee and capping imported inflation. But while the domestic market enjoys this peace dividend, its resilience remains on a collision course with external pressures, from global AI tech volatility to mounting U.S. fiscal headwinds. This chart tracks Brent crude's drop from over $120 a barrel. With conflict avoided, prices settled into the $86 to $89 range. Every $10 drop cuts roughly $20 billion from India's current account deficit. These macro savings translate directly into margin relief for domestic manufacturing and logistics. They also helped cap retail inflation at 3.93%. With core energy inflation stabilized, the Reserve Bank of India now has the critical breathing room needed to maintain its paused interest rate cycle. This waterfall chart illustrates the RBI's new swap schemes for foreign currency deposits and external borrowings. Projected to attract $50 billion, this effectively halves India's balance of payments deficit. Anticipating these inflows, the rupee has aggressively strengthened into the 94.95 to 95.25 range. That currency stability shifted the character of the domestic equity space. We are no longer seeing a broad recovery, but a localized stock pickers market. Investors are now rotating capital selectively into sectors like financials and power, driven by company-specific fundamentals rather than macro momentum. Right now, consistent retail SIPs and domestic mutual fund inflows provide a heavy layer of insulation for the local market. However, foreign institutional investors remain cautious. Sustained high interest rates in the US or a sharp correction in the global AI technology sector could quickly trigger aggressive foreign outflows. Domestically, a severe El Niño threatens the upcoming monsoon season. A rainfall deficit would directly hit agricultural yields and depress rural demand. India's financial core is well capitalized, but these dual threats, external tech corrections and local climate risks, can destabilize this delicate equilibrium. The geopolitical peace dividend has given India crucial time to cool imported inflation and correct the value of the rupee. With global risks looming, broad passive indexing is positioned to underperform. Outperformance will require active stock picking in sectors with clear earnings visibility, specifically banking, manufacturing, and power. To navigate the next quarter, pivot to high conviction trades, closely monitor the 60-day US-Iran ceasefire, and build hedges against Q3 monsoon risks.